to the market the very next day. That's the tax you pay for overconfidence. The truth is, the right move after a big win is to do nothing, to walk away, clear your head, and let your pulse settle. Markets don't care about your last trade. They don't know you won. That's why I say the worst time, that's when you're most dangerous to yourself. Now let's step back for a moment. Why do these 2 times uncertainty and post-victory destroy traders? It comes down to human nature. Human beings hate waiting. We want movement, we want action, we want results. The market, however, doesn't reward action. It rewards discipline. Did you ever notice that the biggest fortunes aren't made by men who trade every day, but by men who trade at the right time? I've seen fellows who couldn't sit still lose a lifetime's savings, while another man who sat tight through a whole campaign walked away with riches. And it reminds me of what we spoke about in that earlier lesson, the rule that makes trading predictable. The rule only works because you're willing to wait for the market to line up with it. Predictability comes from repetition, from patterns repeating over and over. But if you step in during the uncertain stretches, you're trying to force predictability where there isn't any. Do you see the trap? The rule works, but only if you respect the timing. You must understand, wealth in markets isn't built from catching every tick. It's built from catching the right swing and holding it. When I talk about patient waiting, I'm not talking about sitting idle forever. I'm talking about reserving your capital, your energy, and your courage for the moment when the tape tells you the truth. And the tape always tells the truth, if you know how to read it. But only a fool demands it speak when it has nothing to say. Have you ever forced a conversation with someone who clearly didn't want to talk? The more you push, the more awkward it gets. The same with markets, better than nonsense. Now let me confess something to you. I haven't always been patient. In my early days, the ticker tape was like a siren song. Every fluctuation was a call to arms. I thought I had to be in the market every day to prove I was a trader. But the market doesn't pay salaries, it pays for results. And the result of overtrading is ruin. It took me years and more losses than I like to admit to realize that my job wasn't to trade often, but to trade well. There's an old saying in Wall Street, the market is never wrong, but men often are. I'd add something to it, the market never hurries, but men always do, and it's the hurrying that kills. When I look back, my greatest profits didn't come from clever entries or lightning-fast exits. The temptations, sitting through the fear and the greed, and sitting out when the time was wrong. So, when is the time wrong? Let's make it simple. The time is wrong when you don't see the line of least resistance. If the tape isn't showing a clear trend, step aside. The time is wrong when you've just scored a victory and your blood is still hot. Step aside again. That's the discipline most men lack, and that's why most men fail. Have you ever stopped to wonder why only a handful of traders grow truly wealthy while the rest scrape by or wash out? It isn't knowledge alone, it's temperament. The market is a great equalizer of knowledge, but it punishes weak nerves. And this is where money mindset comes in. Because the man who must trade every day is a man desperate for income. He sees the market as his paycheck, market as a machine that pays only when conditions are right. He doesn't beg it for a wage. He waits for it to offer a fortune. That's a different way of thinking, isn't it? Instead of needing the market, you let the market need you. Tell me, do you see the power in that? When you're free from the need to trade, when you can afford to sit out the bad times, you suddenly become the hunter instead of the hunted. That's how fortunes are made, not in the busy hours, but in the waiting hours. But because they can't resist doing what they shouldn't. They know the market is unclear, but they jump in anyway. They know they're high on a big win, but they trade again anyway. And so they pay tuition to the market dearly. The real secret, if there is one, is this: learn to sit tight, not just on your winning positions, but also on your hands when the time is wrong. That's twice as hard and 10 times as valuable. Because when you wait out the 2 worst times to trade, you preserve not only your capital, but also your confidence. And confidence preserved is opportunity preserved. Have you ever noticed how one bad trade in the wrong moment can poison your mind for weeks? That's the hidden cost of impatience. A bad entry during uncertainty, or a reckless trade after a big win, doesn't just hurt your wallet, it clouds your judgment for the next campaign. Suddenly, you're second-guessing yourself. You're no longer trading the market, you're trading your fear. That's why I waited patiently, because I learned the hard way that waiting costs nothing, but impatience costs everything. And when I say waiting, I mean waiting actively, watching the tape, studying the action, preparing for the moment when the line of least resistance finally appears. Not idling, not dozing, but waiting like a cat crouched before the strike. Now
We have got to the point where literally anybody can build a fully working app without knowing how to code. This is base 44.
Now you might ask yourself, but Jesse, if I'm not trading in those times, what am I doing? You're doing the work that others are too restless to do. You're observing, recording, analyzing. You're building the habit of self-control. And believe me, that habit is worth more than any single trade. Because in this game, the biggest profits don't go to the man who trades the most, they go to the man who makes the fewest mistakes. And the biggest mistakes are made in those two bad times. So when I tell you not to trade in uncertainty and not to trade after victory, I'm not preaching theory. I'm telling you how I lost fortunes and how I saved them. I'm telling you the truth the tape whispered to me again and again until I finally had the sense to listen. And the tape only whispers one thing in those moments: sit down. Be patient. The right time is coming. After a man has tasted success in the market, the danger isn't always from the ticker tape itself, but from what happens in his own head. Victory has a way of changing a trader's pulse. It makes his hands lighter on the trigger, his judgment softer, and his conviction sloppier. The moment after a big win is the most treacherous, because it's when confidence turns to carelessness and careful reading of the tape turns into emotional chasing. That is why I say the worst time to trade is right after you've made a killing, because that's when you're least likely to see the market for what it is. You're blinded by your own triumph. Think about it. Have you ever walked out of a casino after hitting the jackpot on a slot machine and thought, I can do it again? That same pull happens in the market, only more dangerous, because the stakes aren't chips, they're your capital, your livelihood, your future. The tape is not a slot machine, but the mind convinces itself otherwise when success strikes. You believe the market is suddenly aligned with you, like you've found a secret key, as though the profits came from your brilliance instead of the natural movement of prices. That illusion is poison. The tape doesn't remember your last win. It doesn't know you were right yesterday. It doesn't owe you another fortune today. But how many traders fall into that exact trap? They finish a strong campaign, and instead of stepping back to let their pulse settle, they double down. They increase their size, they shorten their patience, and they stop waiting for the line of least resistance to show itself. In other words, they stop trading the market and start trading their emotions. Tell me, have you ever made a trade not because the setup was there, but because you felt invincible? That's the post-victory danger, and it ruins more men than the losses ever do. I remember one campaign in cotton that paid me enough to make any man comfortable. I had studied the tape, waited for the right setup, and ridden the swing patiently until it delivered. The profit was real, the reasoning behind it sound. But the next morning, flush with victory, I couldn't resist. I saw trades everywhere, even in places where the market was silent. I mistook noise for signal. The result, I gave back more than I should have, not because the market turned against me, but because my own judgment betrayed me. Success clouded my mind more than any failure ever had. The strangest part about victory is that it feels like proof of ability, when often it's proof of patience. But traders forget that. They credit themselves with skill when it was their discipline that paid them. And because they confuse the reason for their success, they misapply it the very next day. That's why after a big win, the best action is no action at all. It sounds simple, but it's the hardest thing in the world to do. Now, why is it so hard to stop after winning? Because the human mind craves repetition of pleasure. It's wired into us. One win creates the urge for another, just like one drink leads to two. But the tape doesn't work like that. The market doesn't give you victory on demand. It rewards you when the setup is right, when the conditions are in place, when the line of least resistance is clear. If you try to force another win simply because you want it, you're gambling, not trading. Have you noticed that a trader who just won big often trades larger size than before? It's as if he wants to prove to the world and to himself that his success wasn't luck. He raises the stakes, believing the market has confirmed his greatness. That is the precise moment when the market delivers its harshest lesson. Because markets don't confirm greatness, they test it. And they do it with ruthless consistency. The cure is simple to say, but hard to practice after a win. Cool off. Step away from the ticker. Close the books for the day, or even for the week if the campaign was large. Let the victory settle into your account before it unsettles your judgment. Think of it like cooling iron after it's been forged. If you rush it, the steel warps and weakens. Your trading mind is the same. It needs time to harden again before facing the fire. Another trap after a big win is the tendency to abandon your rules. You think, I've got a cushion now, I can afford to take a chance. But chances aren't trades. The moment you justify a position with I can afford it, you're no longer trading with discipline. You're spending your profits like pocket change. That's how easy money turns into lost money. Have you ever heard of a man who made a fortune in one campaign only to lose it in the very next? It's nearly always because he stopped respecting his own rules. He let success loosen his grip. This is where the connection to money mindset comes in. A poor mindset treats profits like sudden windfalls to be spent or risked. A wealthy mindset treats them like seeds for the next harvest. But you can't plant seeds if you're too busy gambling them away. After a win, your job isn't to prove you can win again immediately. Your job is to protect what you've earned and prepare for the next true opportunity. The man who rushes back into the market after victory is the man who shows he doesn't trust patience to serve him again. When I talk about waiting, I don't mean sitting idle in ignorance. I mean active waiting, studying the tape, watching for confirmation, making notes, testing your own emotions. The real challenge after a win is whether you can go back to being a student instead of playing the role of a champion. Danger. That's why the second was the very caution that protects you. The tape doesn't need to fool you. Your own emotions do the job. One of the wealth building principles that traders overlook is capital preservation after success. The big win you made isn't just money, it's momentum. It's proof you applied the right principles and held your nerve. That foundation lets you size up when the next true trend appears. But if you waste it in overconfident trades, you're back to where you started, with nothing to show for your discipline, but regret. Now let me ask you, how many of your own winning streaks ended not because the market truly changed, but because your behavior did? The victory was there, the conditions were still ripe, but you squandered your strength by jumping, not faulty reading of the tape. Think of it as a test from the month. Resist the thrill. The few who pass are the ones who grow truly wealthy. The market is a clever beast, his stake before disease, and the market knows how to. It doesn't have to do when conditions are unclear, will. But most may bleed capital little by little. Your hands twitch, thinking, I need to do something. That's the moment danger sets in, because the ticker is just spitting out noise, yet your imagination turns that noise into opportunity. You start seeing patterns that aren't there, signals that don't exist, and moves that never come. The tape isn't lying, it's just not speaking. And when the tape is silent, you must learn to be silent too. The market loves impatient men. It lives off their commissions, their premature stops, their false entries. It thrives on their need for action. I've watched countless traders who couldn't resist the urge to play every wiggle. They believed the game was about constant action, like a soldier firing every bullet he carries. But the battlefield of Wall Street is different. Waste your ammunition on shadows, you'll have nothing left when the real enemy shows his head. In my early years, I made the same mistake. The ticker tape was like a riddle I felt compelled to solve every minute. I thought trading meant acting on every fluctuation, proving my skill by catching each move. But do you know what happened? I earned small wins here and there, but they were drowned out by the constant costs of being in the market when it had nothing to offer. Restlessness drained my account far more efficiently than a single bad trade ever could. There's a peculiar thing about restlessness. It makes a man believe he's working hard, when in fact he's just spinning his wheels. He thinks activity equals progress, but trading isn't like swinging a hammer or plowing a field. In those trades, effort produces output. In markets, effort without timing produces losses. The only effort that matters is the discipline to wait. Have you noticed how difficult it is to convince yourself that waiting is work? That's why so many fail. They confuse business with productivity, and they let the market teach them the difference in the harshest way possible. Now, let me ask you, how many trades have you made in your career simply to avoid the discomfort of doing nothing? Trades not backed by a clear line of least resistance, but by boredom or anxiety. If you add them up honestly, you'll see that they probably cost more than your big, obvious mistakes. Because restlessness is a slow leak. It empties the tank without you realizing it, drip by drip. And when the true opportunity finally arrives, you're too drained financially or mentally to take advantage of it. The principle of avoiding unclear conditions is not just about protecting money, it's about protecting judgment. Every bad trade you make in a restless state clouds your thinking. You become reactive, chasing losses or chasing the illusion of momentum. The tape stops being your guide and becomes your excuse. Instead of studying the action, you justify it. That's when trading turns into gambling. And gamblers, as you know, never last. I remember a stretch in my career when I forced myself into trades during a sideways market. Prices would move up for a few points, then down for a few points, back and forth with no conviction. I convinced myself I could outwit the chop by being quicker than everyone else. I thought I could scalp my way to fortune. What actually happened was death by 1,000 cuts. Each trade small, each loss minor, but the pile grew until it dwarfed the profits from my last campaign. The market didn't do that to me, I did it to myself. That's the punishment of restlessness. It's not sudden. It's steady, grinding, merciless. And here's the hardest truth. Restlessness feels productive because you're active, but it's really the market's way of testing your discipline. Can you wait? Can you watch the ticker spit meaningless numbers without needing to act? That's the exam every trader faces, and most fail it. The men who pass the ones who can sit tight when the tape is muddled, those are the men who last long enough to catch the next great trend. This ties directly to how you think about money. A restless trader sees the market as a daily wage. He thinks he needs to extract profit every session, or else he's failed. That mindset forces him into the market even when the conditions are poison. But the wealthy trader knows better. He doesn't need the market to pay him every day. He only needs it to pay him when the odds are right. He can sit idle for weeks if necessary, because he understands that one good swing is worth 100 bad scalps. That's wealth-building thinking, not paycheck thinking. Have you ever considered why the great fortunes came from long campaigns, not from constant trading? Men like me didn't grow rich by jumping into every move. We grew rich by waiting for the right move and then riding it without distraction. The difference between the wealthy trader and the restless trader is simple patience. The wealthy trader spends most of his time doing nothing, while the restless trader spends most of his time undoing himself. Restlessness also affects your emotions in ways you don't notice until it's too late. A string of small, needless losses makes you timid. It erodes your confidence. So when the market finally does reveal its true line of least resistance, you hesitate. You second-guess yourself. You think, maybe I'll wait one more day, and that day is the day the move begins without you. Do you see the cruel irony? Restlessness in dead times makes you paralyzed in real times. It robs you twice, once in money, and again in courage. There's an old saying in trading that the hardest thing is not knowing what to do, but knowing when not to do it. I believe that with all my heart. The tape doesn't always speak clearly. Sometimes it whispers, sometimes it mumbles, sometimes it says nothing at all. In those moments, if you force it to tell you a story, you'll invent one, and the story you invent will cost you. That is how the market punishes restlessness. It lets you trick yourself. The great secret is this: sitting still is a position too. It's the strongest position in the world when the market is uncertain. It costs nothing, it risks nothing, and it preserves everything. Yet most men treat it as weakness. They can't bear the thought of inactivity. So they pay for their need to act, and the market thanks them kindly. If you want to last in this game, you must learn to enjoy the quiet periods, to see them not as wasted time, but as necessary preparation. Every campaign I ever made began in silence, in waiting, in observation. The silence tested me, and when I passed, the market revealed the move. That's the rhythm of trading. But the restless trader skips the silence, and so he misses the move. Have you noticed how the market always seems easiest to read in hindsight? That's because the restless man was too busy trading noise to see the signal forming. The man who waited sees it clearly, because his judgment wasn't clouded by a string of useless trades. Patience sharpens your vision, while restlessness blinds it. A man's mindset about money determines everything he does in the market. You can give two traders the same chart, the same information, the same conditions, and they will act differently depending on how they think about money. One sees the market as a paycheck, something that must provide for him every day, no matter what. The other sees it as an opportunity machine, something that pays him only when conditions are ripe, but pays him handsomely when they are. That difference in mindset is the difference between scraping by and building wealth. When a trader approaches the market like a job that must deliver daily wages, he puts himself in bondage. He forces trades because he feels he cannot afford to miss a day. He measures success in short intervals, like a man who counts every coin in his pocket before going to bed at night. But the market doesn't operate on wages. It doesn't reward constant activity. It rewards alignment with the line of least resistance. If you demand daily pay, the market will give it to you, but it will be negative because commissions, slippage, and bad trades will eat away at your account. Have you ever noticed how trying to make money every day ends up costing more than it gives? That's the trap of a paycheck mindset. The wealthy trader, on the other hand, doesn't think in terms of daily needs. He thinks in terms of campaigns. He knows that money in the market doesn't come like a salary, it comes in chunks, irregular, unpredictable in timing, but dependable in principle. It comes when he aligns himself with the big move, when the market tips its hand and shows him where the pressure lies. That might not happen every day. It might not even happen every week. But when it does, it pays enough to make the waiting worthwhile. The wealthy trader accepts the unevenness of the game. The poor trader fights it. Which do you think the market favors? I learned this difference the hard way. In my early days, I thought I had to trade constantly because I needed to see the money flow in. If a day passed without a profit, I felt like I was failing. I forced trades to satisfy my need for activity, and those trades chipped away at my capital. The irony is, the days I thought I was working hardest were the days I was working against myself. It wasn't until I shifted my mindset, treating the market as an opportunity machine instead of a wage dispenser, that I began to see real wealth accumulate. Tell me, have you ever looked back over a month of trading and realized that nearly all of your profits came from just one or two campaigns, while the rest of your trades added little or even took away? That's the lesson in plain sight. The market doesn't care how many times you trade. It cares how well you catch the big swings. But to catch those swings, you need patience. And patience only comes when you free yourself from the idea of needing to be paid daily. Think about farming for a moment. A farmer doesn't plant seeds today and expect to eat tomorrow. He waits for the season, tends his fields, and harvests when the time is right. He doesn't dig up the soil every day to check if the crop is growing. If he did, he'd ruin the harvest. Yet traders with a paycheck mindset do exactly that. They dig up their capital every day, looking for results. destroying the very growth they hope to nurture. The wealthy trader is more like the farmer. He plants when the setup is right, he waits while the market develops, and he harvests when the line of least resistance plays out. Another part of the money mindset is how you view losses. The paycheck trader sees a loss as a failure, as a deduction from his supposed daily wage. That makes him fearful, reactive, unwilling to take the necessary risks when the opportunity arises. He trades small, trades often, and stays timid. The wealthy trader sees losses as part of the cost of doing business, like a farmer sees bad weather. He doesn't measure himself by any single day's outcome. He measures himself by campaigns, by seasons, by the larger arc of his capital.
Man!
Sometimes, you could have done better.
Hello guys, thank you for joining my live. Appreciate all your
Professional
likes,
speculator
comments.
does not trade in a chaotic market. He waits with the supreme patience of a master for the rare and fleeting moments of perfect clarity. He is not a gambler, throwing his capital at every passing fluctuation. He is a hunter, a man who knows that the greatest opportunities do not appear by chance, but are the result of a precise and powerful confluence of ideal conditions. The amateur is forever lost in the noise of the market, but the master is listening, single, study.
So I don't know if you can see or if you can tell from my previous being at NZD Cash. They both hit take profit. Knew the direction of the market. I got taken out of the sell, so the market made an instantly parabolic. So we didn't win on any buy trades. This candle from the news yesterday. Let's see price go back up here from where this parabolic candle. Something light, something simple. Watch the market and showing what I'm doing live with confidence because I'm building with the Forex at the same time. See a little bit more.
This channel going. The 5-star setup is built. Begin to attempt failures. That fighting the primary trend is the thing to do was to be bullish in a bull market and bearish in a bear market. Eagerness for constant action to diagnose the character of the market as a whole. Down approach. Before he ever looked at a single stock, he looked at the environment. He knew that the big money must necessarily be in the big swing. To capture that swing, a speculator must be on the right side of the market's most powerful, all-encompassing force. The most critical star is not perfectly aligned. His behavior, the effect of the market's in its movements. New channel. Richard Wyckoff trading with the checklist moves to the next critical level of filtration. The industry groups of the trend is never evenly distributed. It is all the generals of the market army, studies and his capital to these prominent leading groups. To spread oneself thin across the entire market, much easier to watch a few than concentration, not diversification. He knew that if he could correct, he stated it as a fundamental law. Whose component stocks were the first to make new highs. It was a visible, tangible thing to the trained. It narrows the speculator's focus from the ignoring the 90% of the market that is mediocre market-leading groups. Can the second star of a 5-star setup? The speculator has achieved a level of clarity that eludes the vast majority of the single strongest fleet, the leading industry group that is sailing most powerfully upon that tide. He is no longer lost in his purpose clear. But the test is not yet complete. The next steps are the most refined, the tactical maneuvers that narrow the focus from the leading fleet down to the single flagship, and then to the precise psychological order. This brings us to the third and star number 3. The stock must be the leader within its. There will always be one or two undisputed generals, the true leaders that move first, advance fastest, and demonstrate the most profound and resilient strength. The other stocks are mere soldiers in the ranks, following the commands of their leaders. The professional speculator is interested only in the generals. The amateur, in his perpetual and misguided quest for a bargain, almost always makes a fatal error at this juncture. He sees the leading stock, which has already had a substantial advance, and he deems it too expensive. He looks instead for the laggard in the same group, a stock that has not yet moved, and he buys it, believing it is a safer and more logical purchase. He thinks to himself, this stock is in a strong group, and it hasn't moved yet. It is due to catch up. Unseen internal flaw, some hidden source from participating in its group's prosperity, and through years of costly experience, chooses to follow the group. The profession buys proven, demonstrated strength, and he is by the leader. The leader is not. The leader is the percentage gains on the highest volume, profit-taking with an ease that is almost alive. It is the stock that everyone is watching. Pain in the steel stocks during the war boom was a entire group, but he did not buy all the steel stocks. Copper. From the very first day, U.S. Steel Act, Utah Copper, in contrast, was sluggish. His full financial firepower on the proven leader. Single disciplined decision was the key to one of his most profitable. Negative example. While the entire automobile was to advance, the public tape saw its weakness not as an opportunity, and the stock's internal problems were finally revealed. He had shunned the laggard and in this case bet against it. The test arrives at its fourth and most psychological. The stock must be at a pivotal point. The speculator now has the right market, the right group, if his timing is flawed. To be correct in your financial death, you will be whipsawed by meaningless fluctuations, your capital and your nerve eroded long before the real profitable move ever begins. Livermore knew more than any other trader that timing was everything. He wrote, "Much depends upon beginning at exactly the right time. It took me years to realize the importance of this. It also cost me some hundreds of thousands of dollars." The amateur is consumed by impatience, by a frantic need to be in the market. The professional, in contrast, must cultivate the supreme and difficult art of waiting. He must sit, sometimes for days, sometimes for weeks, his capital held in reserve, until the market itself gives the final, unequivocal signal that it is ready to move. This signal, for Livermore, was the decisive breach of a pivotal point. This was his psychological moment, the point in time and price where the long period of quiet preparation was over, and the public marking up phase was about to begin. For the speculator following this plan, the simplest and most powerful pivotal point to watch for is the moment a leading stock makes a new high after a period of consolidation or a natural, healthy reaction. It is only at this precise juncture, and not a moment sooner, that the first commitment should be made. His legendary campaign in Bethlehem Steel was the ultimate testament to this discipline. For 6 long weeks he watched the stock climb, his bullish conviction growing stronger with every passing day. He saw it move from the 50s to the 80s to the 90s. Every point of advance was a siren's call to his impatience. The amateur would have jumped in a dozen times, but Livermore waited. He was not interested in the preliminary skirmishes. He was waiting for the main event, the signal that the great public advance was about to begin. That signal for him was the breach of the great pivotal point at $100. The moment it was crossed, he acted, and in doing so, he entered one of the greatest trades of his career. This is the great challenge. To sit idly by, to watch a stock that you know is a leader climb higher and higher, requires a level of self-control that few possess. But it is this very discipline that separates the professional from the amateur. The professional is not paid for trading, he is paid for being right. And being right requires waiting for the one single moment when the probabilities are overwhelmingly in your favor. With the completion of this fourth step, the entire analytical phase of the campaign is over. The speculator has successfully navigated the great top-down filtration process. He has confirmed the primary trend of the market. He has identified the leading group. He has selected the strongest stock within that group. And he has had the supreme patience to wait for that chosen stock to arrive at its own perfect psychological moment to act. He has now done everything in his power to tilt the odds in his favor. He is now and only now ready to proceed to the final tactical star of the setup, the execution and confirmation of the trade itself. The speculator who has patiently and methodically navigated the first four steps of this great test now stands at the final threshold of action. The strategic stars have aligned. The great primary trend of the market is in his favor. The tactical stars have aligned. He has identified the leading stock in the leading group, and that stock has now arrived at its own perfect psychological moment, the pivotal point. The setup is almost perfect, but the master speculator even now does not act on a four-star signal. He demands one final, irrefutable confirmation, the market's own great roaring endorsement of the move. He waits for the fifth and final star to align. This brings us to the ultimate confirmation, the signal that transforms a high volume. Volume is the great engine of any market move. It represents the force, the power, and the conviction behind the price. A breakout that occurs on a quiet, low-volume day is often suspect. It suggests a lack of broad participation, a flimsy, half-hearted move that can be easily and swiftly reversed. It is a house built on a bedrock of immense and aggressive demand. Livermore knew that this surge in volume was the final, critical sign that a broad and powerful consensus had been reached. It was the signal that other great market participants, the floor traders, the public, and perhaps other informed interests, were seeing the same thing and were acting on it with force. It was the market's own way of endorsing the move, of providing the great propulsive thrust necessary for a sustained and powerful advance. The breakout in price was the signal, but the surge in volume was the signature that proved it was genuine. This, then, is the complete five-star setup, the great and timeless pattern that Jesse Livermore trusted above all others. It is not a simple two-dimensional pattern on a chart. It is a multi-dimensional, logical, and sequential process, a complete campaign plan that moves the speculator from the broadest strategic overview down to the finest tactical detail. It is a journey of filtration and confirmation, a method for ensuring that when you finally do risk your capital, the great impersonal probabilities of the market are overwhelmingly on your side. Let us synthesize it into a single cohesive process. It begins with star number one, the general market trend ensuring the great tide is at your back. It moves to star number two, the leading industry group, ensuring you are sailing in the fastest current. It narrows its focus to star number three, the leader within the group, ensuring you are on the fleetest ship. It demands the supreme patience to wait for star number four, the pivotal point, the perfect moment to board. And finally, it demands the ultimate confirmation of star number five, the surge in volume, the great roaring engine that signals the voyage is truly underway. To follow this five-step process is to understand that the five-star setup is not merely a technical pattern. It is a mental discipline. It is a commitment to the difficult and often frustrating art of waiting. The 90% fail because they are content to act on a one-star or two-star signal. They are driven by impatience, by the constant nagging need to be in the action. The professional, the 10% who win, has the ironclad fortitude to sit in cash, to watch, and to do nothing, until all five stars, without exception, have perfectly aligned. The five-star setup, then, is the ultimate key to transforming speculation from a frantic emotional gamble into a calm, disciplined, and pro-business. It is a methodology that by its very design eliminates the two greatest sources of amateur ruin: acting on impulse and fighting the primary trend. It is a plan that forces a speculator to be patient, to be selective, and to act only when the evidence is irrefutable. It is not a guarantee of profit on any single trade, for speculation can never be made entirely safe. But it is the closest thing a man can get to a guarantee of long-term, consistent success. It was the foundation of Livermore's greatest victories, and it remains the only true path for the speculator who is serious about his craft. To truly understand the mind that forged these principles, it is not enough to simply know the rules. You must understand the man, the very soul of the speculator. For this, there is no greater journey you can take than to immerse yourself in Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not a dry textbook of market theories. It is a deep psychological odyssey, a flight simulator for the trader's mind. Lefebvre's genius was not just in telling Jesse Livermore's story. It was in capturing his internal monologue, the constant churning dialogue of doubt, of conviction, of fear, and of the brilliant flashes of intuition that defined his career. Reading it, you do not just learn his methods. You feel the gut-wrenching pain of his million-dollar blunders and the quiet, profound satisfaction of his greatest triumphs, all without risking a single cent of your own capital. For those truly committed to this deep study, we highly recommend the edition, which includes a unique, detailed chapter-by-chapter analysis by Max Davidson. This analysis acts as your co-pilot, translating the century-old wisdom of the text into a clear, actionable roadmap for the modern trader, ensuring that the lessons learned in 1923 are as powerful and as profitable today as they were then. A link to this essential edition is provided in the description below. For the speculator caught in the relentless downward spiral of losses, there comes a moment of profound crisis. The capital shrinks, the confidence shatters, and the market, which once seemed a field of boundless opportunity, transforms into an arena of certain defeat. He tries to fight back, to win back what he has lost, but every trade only deepens the wound. He is trapped in a cycle of hope and despair, his decisions no longer guided by logic, but by a desperate, frantic need to get even. It is at this very moment, on the brink of total ruin, that a radical intervention is required. Not a new tip, not a new system, but a complete and total reset of the mind, the methods, and the man himself. Jesse Livermore knew this state of crisis more intimately than any man. He had walked this path to the poorhouse not once, but several times, losing colossal fortunes in the process. Yet his genius was not just in his ability to win, but in his remarkable capacity to recover, to rebuild, and to return to the market stronger and wiser than before. He did this not by chance, but by adhering to a strict, methodical process of psychological and strategic reconstruction. He had, in effect, a personal action plan for stopping the bleeding, for silencing the emotional chaos, and for re-establishing the foundations of professional, profitable speculation. And this is that plan. It is not a promise of quick riches, for Livermore knew that easy money is a myth. It is a promise of something far more valuable, a path back to discipline, a 30-day guide to stopping the cycle of losses and rebuilding your entire approach to the market from the ground up. It is a plan that demands patience, honesty, and an unwavering commitment to its principles. But for the trader who is truly serious about survival, who is ready to abandon the flawed habits of the amateur and adopt the mindset of a master, this plan is the key to salvation. This action plan is a distillation of the lessons scattered throughout a legendary career. To truly understand the full epic story behind this plan, the failures that necessitated it and the victories that proved its power, the essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master speculator at work. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. Before we begin, there is one foundational, non-negotiable premise. For the majority of this 30-day period, you will not place a single trade. This may sound counterintuitive, even impossible to the man who feels an anxious need to be in the market. But it is the most critical component of the entire process. Your primary objective for the next 30 days is not to make money. It is to stop losing it. And the only certain way to stop losing money in the market is to not be in it. This is not a passive retreat. It is a strategic, tactical withdrawal to repair your equipment and redefine your battle plan. Week 1. The Great Pause and Brutal Self-Analysis. The first 7 days of this plan are dedicated to a complete and total separation from the market and a rigorous, unflinchingly honest examination of your past mistakes. The first step to curing a malady is to correctly diagnose it. You must turn off the ticker. You must delete the market apps from your phone. You must cease all conversations about stocks. As Livermore did when he sought clarity, you must find your own version of a quiet fishing trip, a place of mental solitude where the frantic noise of Wall Street cannot reach you. With the market silenced, your work begins. You must become an archaeologist of your own financial ruin. Take out your brokerage statements from the last 6 months or the last year. Spread them before you. This is the unvarnished, factual record of your trading, and it contains the secret to your failure. Your task is to perform a post-mortem on every single losing trade, no matter how small or how painful. You must become a cold, detached scientist, studying your own errors with a clinical eye. For each losing trade, you will ask a series of questions, the very questions Livermore implicitly asked himself after every one of his own devastating defeats. First, did I act on a tip or on inside information? Be honest. Was the trade your own idea, born of your own study, or was it a borrowed conviction, a whisper of hope from a friend, a broker, or an anonymous source on the internet? Livermore learned at a cost of millions to beware of all inside information. He knew that the man who trades on a tip is a man who does not know how to exit, for the reason for selling is never passed along with the reason for buying. Second, for each loss you must ask, did I average down this position? Look at your records. Did you add to the trade as it moved against you? Did you buy more at a lower price, hoping to improve your average cost? If so, you have identified the cardinal sin of speculation. You are reinforcing failure, throwing good money after bad. Livermore was absolute on this point. Of all speculative blunders, there are few greater than trying to average a losing game. You must identify every instance of this fatal habit. Third, ask yourself, did I hold on to this loss out of hope? Look at the history of the trade. At what point did you know in your gut that it was a mistake? At what point did the tape tell you that you were wrong? And how long after that signal did you hold on, hoping for a miraculous reversal? This is the measure of your emotional discipline or lack thereof. Every day you held a losing position after it was proven wrong was a day you chose hope over facts, a decision for which the market always exacts a punishing fee. Fourth, ask the strategic question. Was this trade aligned with the primary market trend? Look at the overall market during the time of your trade. Were you trying to buy a stock in a clear bear market, or sell short in a roaring bull market? Were you fighting the great underlying line of least resistance? Livermore knew that the big money was only ever made by trading in harmony with the primary trend. To fight it was to guarantee an eventual costly defeat. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. By the end of this first week, you must have a written, brutally honest diagnosis of your own speculative failures. You will likely find a recurring pattern, a small handful of critical errors that are responsible for the vast majority of your losses. You are no longer ignorant of the cause of your affliction. You have looked your enemy in the eye, and you have discovered that it is, and always has been, yourself. This is the first and most difficult step toward recovery. Week 2, the study of the tape and market structure. Having diagnosed the errors of the past, your second week is dedicated to understanding the realities of the present. You will now return to watching the market, but with a critical difference. You will return not as a desperate participant, but as a detached, scientific observer. You will not place a single trade. Your only job is to watch, to listen, and to learn the language of the ticker tape. You are no longer a gambler, you are a student. Your first task is to identify the overall character of the market. Apply Livermore's first and most important question. What is the line of least resistance? Is the market as a whole in a primary bull trend or a primary bear trend? Watch the price action. Is it making higher highs and higher lows, or lower lows and lower highs? Forget the news, forget the opinions, forget your own hopes and fears. What are the facts as registered by the tape? Once you have a clear conviction about the market's primary trend, you will begin the next phase of your study, identifying the leaders. Apply Livermore's second great filter. Which industry groups are showing the most strength, leading the advance or the decline? Within those groups, which individual stocks are the undisputed generals, moving first and with the greatest force? And which are the laggards, the weaklings that refuse to follow? You are to become a student of group behavior, a professional assessor of relative strength. During this week, you will begin the most important practical habit of your new career. You will start your own records. As Livermore did, you will begin meticulously recording the price movements of the market leaders you have identified. You are not just watching prices. You are documenting them, studying their rhythm, their patterns of advance and reaction. You are looking for the formation of his pivotal points, the key strategic levels where the next great move will be born. The goal of this second week is to achieve a profound and lasting shift in your mindset. You are to transform yourself from an emotional, hope-driven gambler into a cold, detached, fact-based analyst. By the end of this week, you will no longer see the market as a chaotic casino, but as a structured, logical entity with its own discernible habits and laws. You will have a clear, objective view of the market's present condition, a view based not on what you wish to be true, but on what your own careful, dispassionate observation has revealed to be true. You have diagnosed your past, and now you understand your present. You are now ready to plan for your future. Having completed the first 2 weeks of this action plan, the speculator stands at a critical juncture. He has silenced the noise of the market, performed a brutal and honest post-mortem on his past failures, and has spent a week as a detached, scientific student of the tape. He has moved from a state of emotional chaos to one of analytical clarity. He now understands why he has been losing, and he now sees the market as it is, not as he wishes it to be. He is now ready for the third and most constructive phase of his transformation, the forging of his new rules of engagement. Week 3. Forging the rules of engagement. The next 7 days are dedicated to creating a personal, written, and absolutely unbreakable trading plan. This is the constitution that will govern your every action from this day forward. A speculator without a plan is a ship without a rudder, at the mercy of every emotional current and gust of market sentiment. Livermore knew that his own success was built not on brilliant improvisation, but on the unwavering adherence to a set of sound, well-reasoned principles. Your task this week is to define your own. You will take a single sheet of paper. At the top, you will write, "My rules of speculation." These will be your commandments, the laws you swear to uphold. The first rule you will write governs your entry into any trade. Based on your studies from week 2, the rule is this: I will only initiate a trade at a confirmed pivotal point. This means you will no longer buy a stock because it looks cheap, or because of a tip, or because you are bored. You will wait with the patience of a master for the market itself to give a clear strategic signal that a major move is underway. The second rule you will write governs your risk. This is the most critical rule for your survival. You will write, I will never risk more than a small fixed percentage of my total capital on any single trade. The exact percentage is for you to decide, but it must be small, perhaps 2%. This rule makes the catastrophic, account-destroying loss mathematically impossible. It ensures that you can withstand a series of inevitable small losses and remain in the game. It is the very definition of professional capital management. The third rule is the practical application of your new commitment to risk control. You will write, I will place a hard stop-loss order for every trade before I enter it. I will never move my stop further away from my entry price. This rule removes all emotional indecision from the act of taking a loss. The decision is made beforehand, in a moment of calm rationality. It is the mechanical shield that protects you from the destructive whispers of hope when a trade goes against you. It is the final, non-negotiable execution of Livermore's great principle. Cut your losses quickly. The fourth rule governs your actions when you are right. You will write, I will only add to a position that is already showing a profit. I will pyramid by buying on a scale up. This is your commitment to reinforcing success, the polar opposite of the amateur's fatal habit of averaging down. It ensures that your largest bets are always placed on your most successful ideas, with the market's own momentum as your greatest ally. This is how small initial probes are cultivated into great fortune-making lines. By the end of this third week, you will have this document. It will be your personal roadmap, your strategic and tactical guide. It is the product of your own hard-won experience and your new disgorged money. Your goal is to prove to yourself that victory is in the process, not in observation. You will watch the market leaders you identified in week 2. You will track their movements, waiting for one of them to approach a clear and valid pivotal point that aligns with the market's overall trend. You will not force a trade. If no perfect setup appears for the entire week, then you will not trade. To refrain from trading is, in itself, an act of supreme discipline. You are waiting for the psychological moment, the high probability opportunity your new rules demand. When the setup finally appears, you will execute your plan with the precision of a surgeon. You will consult your new constitution. You will calculate your exact position size based on your fixed risk rule. You will determine your precise entry point and your non-negotiable stop-loss point. You will have your orders prepared, your entire campaign mapped out before you risk a single dollar. Then and only then you will act. You will place your trade. Immediately after, you will place your hard stop-loss order. There is no hesitation. There is only the calm, deliberate execution of a well-reasoned plan. Now, one of two things will happen. The first possibility is that the trade will move against you, and your stop-loss will be triggered. You will be taken out of the position with a small, manageable, and predetermined loss. And in this event, you have achieved a great and profound victory. A victory? Yes. Because the goal was not to be right about the market. The goal was to be right with yourself. You followed your rules. You defined your risk. You honored your stop. You acted with perfect discipline. You have proven that you are no longer a slave to hope, that you can accept a small loss with the dispassionate grace of a professional. This is a monumental achievement, a foundational step in your new career. The second possibility is that the trade will move in your favor, It will show an immediate profit, confirming your timing and analysis. This, too, is a victory. You now have the opportunity to practice the next phase of your plan, the management of a winning position. You will have the chance to apply your pyramiding rule, to have the courage to add to your success. You will trail your stop loss to protect your gains, practicing the art of letting a profit run. Whichever outcome occurs, by the end of this week, you have succeeded. You have broken the cycle. You have replaced emotional, impulsive gambling with a cold, disciplined, and systematic process. You have stopped chasing losses because you have learned to control them. You have stopped trading on hope because you have learned to act on facts. You are no longer the same speculator who began this journey 30 days ago. This plan is not an endpoint. It is a new beginning. It is the foundation upon which a long and potentially prosperous speculative career can be built. The work is not over. It has just begun. The market will continue to test you every day, to tempt you back into your old destructive habits. The battle against fear, greed, and hope is a lifelong one. But you are now armed with a proven set of weapons. You have a plan, you have a process, and you have the hard-won knowledge that success in this great game is not an accident. It is the certain and inevitable reward of unwavering discipline.
Thank you for being here with me on my live. Don't forget to hit the like button, subscribe, share my content. Hit that super thanks for me.
Jesse Livermore was, above all else, a master at identifying these market generals. He did not rely on tips, on fundamentals, or on guesswork. He developed a cold, methodical, and profoundly effective process for filtering out the market's noise and focusing his capital only on those stocks that possessed the character and the power of true leadership. This was not a single secret formula, but a multi-stage test, a rigorous examination that every potential commitment had to pass before he would risk a single dollar. It was a process designed to answer one question: is this merely another stock, or is this one of the chosen few destined to lead the great advance? This process, this leadership test, is a roadmap. It is a systematic four-step guide for moving from a broad overview of the entire market down to a specific actionable trading decision. It is the methodology that allowed Livermore to position himself time and again at the very inception of the market's greatest and most profitable trends. It is a testament to his core belief that speculation is not a gamble, but a serious business. A business that rewards the diligent student and mercilessly punishes the impulsive amateur. This test is not found on a single convenient page in any book, but is a synthesis of a lifetime of wisdom, a collection of principles forged in the heat of the market's greatest battles. To truly understand the mind that devised it, to walk alongside the Great Bear through the panics and booms where these rules were proven, the essential starting point remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book, it is a deep psychological portrait of a master speculator at work. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below. Before we delve into the test itself, we must first understand the philosophy that underpins it. Livermore was adamant that a speculator should never attempt to play the market as a whole. It is dangerous to start spreading out all over the market, he warned. To have an interest in too many stocks at once was to invite confusion and dilute one's focus. He knew that at any given time, the vast majority of stocks are not worthy of a speculator's attention. They are either dormant, moving sideways in a lifeless trading range, or they are weak, lagging behind the general market. The real money, the fast money, the big money, was always concentrated in the hands of the few undisputed leaders. He stated it as a fundamental law. If you cannot make money out of the leading active issues, you are not going to make money out of the stock market as a whole. This was a profound and critical insight. It meant that the speculator's first and most important job was not to find bargains or undervalued situations, but to identify the small handful of stocks that were currently leading the entire market advance. It was a process of radical simplification, of ignoring the 99% to focus on the 1% that truly mattered. This brings us to the first step of the leadership test. Identify the leading group. Livermore never analyzed a stock in a vacuum. He always began with a top-down approach, first assessing the character of the overall market, and then identifying the single industry group that was demonstrating the most power and vitality. He knew that the great market movements were never confined to a single stock. They were sector-wide phenomena. In his day, it was the railroads, then the steels, then the motors. As they go, he said, so goes the whole market. The leading group was not a matter of his personal preference. It was a fact, revealed by the action of the ticker tape. The leading group was the one that emerged from a market correction first, and with the most force. It was the group that made new highs while others were still languishing. It was the group that showed the most consistent and powerful buy, the one that everyone was talking about. To trade against this group, or to ignore it in favor of a weaker sector, was to willingly place oneself on the wrong side of the primary, controlling force of the market. This first step, then, acts as a great, powerful filter, immediately narrowing the speculator's focus from 1,000 possibilities down to a select and manageable few. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Once the leading group has been clearly identified, the second step of the test begins. Identify the leader within the group. Even within the strongest sector, not all stocks are created equal. There will always be one or two undisputed generals leading the charge, while the others follow as mere soldiers in the ranks. The speculator's task is to identify these generals, for they are the ones that will move the furthest and the fastest. They are the true 100-point candidates. Livermore's rule was to always buy the leader, the number one stock in the number one group. The leader, like the leading group, is not a matter of opinion. It is a fact, demonstrated by its behavior. The leading stock is the one that moves first. It is the one that makes the largest percentage gains on the highest volume. It is the one that shows the greatest resilience during market reactions, giving up the least ground and being the first to recover. It is the stock that, in Livermore's parlance, is acting right. It feels strong on the tape. It absorbs profit-taking with ease and seems to be in a constant state of demand. This is where the amateur so often makes a fatal error. He sees the leading stock, which has already had a substantial advance, and he deems it too expensive. He looks instead for the laggard in the same group, a stock that has not yet moved, and he buys it, believing it is a bargain and is due to catch up. Livermore knew this to be a fool's game. He warned, "Experiences have taught me to beware of buying a stock that refuses to follow the group leader. A laggard is not a bargain, it is a weakling. Its failure to advance in concert with its peers is a profound sign of internal weakness, a clear warning of disguised distribution or some other unseen problem." His famous trade in the motor group was a perfect illustration of this principle. He saw the great bull market in automobiles, but he did not buy every motor stock. He focused his capital. At one point, he noticed that Chester Motors was persistently lagging behind the leaders of the group. The public, seeing it as cheap, began to buy it. Livermore, reading the tape, saw its weakness as a definitive sell signal and went short, profiting handsomely when the stock's internal problems were finally revealed. His great campaign in the steel stocks during the war boom provided the positive example. He began his operation by studying both U.S. Steel and Utah Copper. Both were in a leading group, but from the very beginning their characters were vastly different. U.S. Steel was a true leader. It moved with power and conviction. Every purchase he made was met with higher prices. It was acting right. Utah Copper, in contrast, was sluggish. It lacked vitality. Heeding the tape's clear message, he concentrated his full force on the leader, U.S. Steel, accumulating a massive line while keeping his position in the laggard, Utah Copper, to a bare minimum. The result was one of his greatest and most profitable campaigns. This second step, then, is the final and most important filter in the selection process. It is the discipline to ignore the allure of the bargain and to pay up for the proven strength of the leader. It is the understanding that in the business of speculation, you are not